Hi there. Welcome to Commodities. I'm Lindsay Biscaya. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Bloomberg is reporting the war on Iran is pushing LNG exports into the shadows. Qatar is once again moving cargoes out of the Persian Gulf thanks to hiring and navigating practices. Qatar has sent LNG to India and Bangladesh in recent weeks, but both countries paid double the price. The pressure on producers is expected to remain high until a deal to end the war has been reached. Analysts warn commodities like oil and natural gas are in a worsening super squeeze if the Strait of Hormuz remains shut. U.S. President Donald Trump says a memorandum of understanding to reopen the strait could happen over the next week, but there's a lack of clarity on exactly when that could be. Oil and LNG companies heading to Venezuela, meanwhile, are being told to bring their own power plants to avoid frequent blackouts. New regulations call for energy companies to be self-sufficient in power generation. They're expected to be off-grid to avoid stressing Venezuela's weak system. The country has reported 35 outages from January to April of this year. Okay, let's take a look at how some key commodities are trading today. We'll start with the price of energy. Oil is swinging higher as traders weigh the prospects of a potential U.S.-Iran peace deal that we were just telling you about. Iran apparently now reviewing the latest proposal from the U.S. Oil spiking after falling earlier today. It's up nearly 2%. Gas also tracking that as well. Natural gas, meanwhile, seeing a second day of declines after touching 4-month highs last week. It's down by 0.6% today. And if we take a look at where some of the metals are trading, gold is pairing gains after U.S. jobs data surpassed expectations today. That's reinforcing bets that the Feds might keep interest rates higher for longer, which is generally a headwind for the precious metal. Gold up by 0.2%, same with silver. And then we're seeing copper climbing. It is up by more than a full percentage point. It climbed to 14,000 a ton, driven in part by supply disruptions because of the war in the Middle East. And along with copper, aluminum prices have also reached a 4-year high. That's because strikes at major smelters in the United Arab Emirates and Bahrain, combined with the Iran conflict, have reduced production in the Gulf region. Ongoing disruptions in the Strait of Hormuz are also forcing producers to seek alternative shipping routes. So for more on this, let's bring in Commodities regular Bart Mellick, Managing Director and Global Head of Commodities Strategy at TD Securities. It's great to have you join us. Thanks so much.
Well, it's great to be back. Thank you for having me.
So what percentage of the supply of aluminum has been taken off the market since this war in the Middle East began?
Well, I think we can easily say that, out of the 9.5% of aluminum produced in the Gulf, I'd say 2/3 is kind of off the market. Right now, we're looking at deficits as a result of probably around 3 million tons in 2026, maybe 2 million tons next year as well. So we're seeing a very, very rapid decline in inventories, not unlike of what we are seeing in the oil market right now.
That's a lot. I mean, are smelters coming under direct attack right now, or is it just kind of like collateral damage because they're located so close to so many of the major energy infrastructure that has come under attack?
Well, there's been several force majeures ahead of any strikes. Smelters could get shut down because electricity is not flowing, and you might want to, shut it down before there is an emergency shutdown, which would take a very long time to get the smelter back online. But generally speaking, even under benign conditions, if it's a planned shutdown, it'll take 9 to 12 months to reopen a smelter. So, that's one reason, electricity disruptions because of the kinetic strikes in the area. The other one is the Gulf of Hormuz has been effectively shuttered. So a lot of the inputs necessary to make aluminum, let's say bauxite, it may not be flowing in the same amounts you need. You eventually run out of storage capacity as well. So for a variety of reasons, that could include damage to the smelters. We've seen all that production being taken offline. And, just to remind everybody, the region prior to the war has supplied about 9.5% of global supply and has supplied as much as 18% of U.S. Demand. And that's having, a huge impact, not on the LME, but also on the Midwest premiums and other premiums in Europe as well.
And are any of these other big major countries that really are leading in aluminum producing, like Canada, for example, India, China, Russia, have any of these countries kind of stepped up and increased production to compensate for the shortfall that we're seeing from the Middle East?
There's been some of that, but in the end, most of them have been producing at capacity because you don't want to keep a smelter idle. Eventually you will maybe speed up new developments. You will maybe open up plants that were shuttered, but that is all going to take a bit of time. So I expect some of that to happen. As it stands, you are not going to be able to offset the large declines that we've seen in the Middle East. And we will continue to, I think, project very, very substantial deficits this year and next. We don't really see a balanced market until 2028.
2028. Okay. Have we seen, at least in the meantime, like some of these Middle East countries trying to mitigate the impact by using alternate export routes like trucking or rail connections? Is that even a possibility?
Oh, I think there is some, but it will in no way make up for what you can ship through the straits. Eventually that could happen. It could happen with oil as well. Other alternate routes can be developed, but again, that will take time, and depending on how long this conflict lasts, if it's over in the next few weeks and things go back to normal and flows restart, you will have maybe less incentives to do that at scale. For now, I think we are in a fixed situation, and we're going to have to deal with it. The risk for aluminum is that once the war ends, you're not going to have a quick rebound in production because just of the technical challenges to reopen these smelters. And we could see, demand expectations move higher and prices move over and above where they are today. And in our view, to get it to, let's say, 4,000 level, something material would have to happen on the supply side, or we would have to see, big surprises on demand, where we would see demand moving, materially above 2% growth rate for it to go any higher. I think we're at the highs at this point. And I guess we'll see. But this is unprecedented. I think every smelter outside of the Middle East is doing quite well with this price outlook.
Are further shutdowns possible at this point?
Well, look, we're talking the Middle East, we're talking war. If a peace deal does not materialize and we see, kinetic attacks again, I guess anything is possible. We simply don't know. War brings out a lot of uncertainty, and it would be irresponsible for me to say it can't happen, because we all know that in times of war, things that are unexpected typically do happen.
And just to be clear, before we wrap up, like you're saying, you expect normal resumptions to start up again by about 2028. That's if this conflict were to end sometime soon. Is that right?
Yes, I think if we see an end to it, you will see production return, inventories reestablish, and we will see more of a balanced market moving into 2028, which is still, this is June, so this is a year and a half and a bit more away from where we are today.
For sure. Okay, we're going to have to leave it there. Bart Mellick, Managing Director and Global Head of Commodity Strategy at TD Securities. Appreciate your time. Thank you. Coming up, diamond mines in the Northwest Territories make up about 20% of the territory's GDP, but they have been under pressure lately as lab-grown diamonds disrupt the diamond mining industry. We've got more on that next. Diamond mines in the Northwest Territories are one of the biggest drivers of the territory's economy. However, they have been under pressure recently as lab-grown diamonds disrupt the industry. The Ekati mine in particular has been in trouble with its parent company, Burgundy Diamond Mines, teetering on the edge of bankruptcy. And the federal government is providing loans to try to help keep the lights on. So let's get more now from Heather Exner-Perot, Senior Fellow and Director of Energy and Natural Resources and Environment at the Macdonald-Laurier Institute. It's great to have you join us. Thanks so much.
Thanks for having me.
And just before we continue, I want to just give full disclosure to our viewers. Your husband works at the Gahcho Kué mine, which is owned by De Beers. So I just want to make that clear before we start this conversation. But we'll get started now. The federal government, it spent about $200 million to try to keep the Ekati mine from shutting down. What are your thoughts on that funding? And why is it so important to keep this mine up and running?
Yeah, you can see the appeal. Obviously, the diamond sector, the only three mines operating in Northwest Territories are diamond mines. The Rio Tinto Diavik mine just recently went into closure, so we're down to two. Now it looks like down to one really producing, and that's very dramatic for the fiscal situation of NWT. And when we're talking about the Arctic and sovereignty, you might want to, keep things going and keep the mining sector there active. But in retrospect, obviously, they've loaned a lot of money to the company. It only delayed the inevitable for a few months and probably was not, the best decision they could have made.
Now, the government justifying these loans by saying diamond mining is an industry that's being impacted by trade disruptions. How much of the pressure in the diamond industry, from your point of view, is a result of trade issues compared to lower diamond prices as a result of lab-grown diamonds?
Yeah, so most diamonds are used, actually for industrial purposes, not for the jewelry that most of us are aware of. And synthetics, the ability to create synthetics without having to mine in these remote places has become a lot more cost effective and has really undermined the diamond market. And so this is structural. It's not a cyclical thing. And tariffs certainly exacerbated it, but it's more like the straw that broke the camel's back. This was already a commodity that was winding down. These were already mines that were probably going to have to close earlier than anticipated, as we saw with Rio Tinto.
Can you just give us a sense of the industrial purposes that diamonds are used for before we continue?
Yeah, sure. For all the other mining, you often have diamond tips. So diamond is the hardest substance known to man. And so when you're doing drilling, you often need to have something very hard. So it's anything that, you need it to be harder than everything else. And so that's, usually the purpose, and it's a different price and it's a different sector. And so some of the Northwest Territories mines have tried to use that luxury brand, the fact that it is, billions of years old, to compete and create a niche market. But it's just been too small of a market to really absorb all of that.
And the Northwest Territories, obviously, it's a huge industry for the Northwest Territories. It's currently undergoing devolution, meaning the federal government is transferring some of its powers to the territorial government. What do you think the territorial government should do in terms of keeping the diamond mining industry up and running?
Yeah, and this is where it gets interesting because the Northern Territories don't have provincial-like powers. And so through the process of devolution have accumulated some of those. On the one hand, that's good. They have more control over the resources and the royalties. On the other hand, the federal government used to have liability and used to be able to absorb when things would go wrong like this. And so you're seeing the responsibility as well as the rights that NWT is now facing. And so having to cover something like the liabilities if the Ekati mine goes bust, that is going to be difficult for the NWT to absorb. And another reason why the federal government might have felt inclined to step in and help that mine stabilize so that they can cover the other liabilities that they have going forward.
And the diamond mining in the Northwest Territories is responsible for about 20% of the GDP there, right? So how would the decline of this industry in the coming years impact the lives of peoples that live in the Northwest Territories, not just the people that work in those mines?
Well, and this is the main issue, and it's been as high as 25%, when the prices were doing a little bit better. And the mine certainly began very profitably, and it led NWT to have a big boom, and it was probably the highest per capita GDP in the whole country. Now that has diminished, but we're coming into the upswing of commodity cycle. We're focused on the Arctic, and it's very likely that within a year and a half, there will be no operating mines in the Northwest Territories, which will be very surprising to some people. Now, the mining sector obviously provides provide tremendous jobs, well-paying jobs, also contracts to Indigenous communities, Indigenous corporations that have made hundreds of millions of dollars, impact and benefit agreements, things that are difficult to replace with, say, tourism or even defense spending. You just don't get the tax take and the royalty intake that mining provides there.
So then if diamond mining is diminishing and not an option in the future, what other options do you see for the Northwest Territories to develop their economy? Because you say policy for economic development in the Northwest Territories is even worse than places in like the Yukon or Nunavut, for example.
Yeah, so if the Fraser Institute does its annual survey of mining executives, it finds that pretty much the Northwest Territories has the worst ranking in Canada, in North America, in terms of attractiveness of policies. So certainly defense spending will cover a little bit of the gap. Mining reclamation will also cover a bit of the gap, but those aren't industries that you really want to build your economy on. And so hopefully this is a wake-up call for NWT to do the things it needs to do to become attractive for bigger miners, bigger investments in the future. They have timing on their side. We are going into a commodities upswing. They have gold, they have base metals, they have rare earths, they have lithium, and let's see if they can be an attractive enough jurisdiction to get some of that back.
And just lastly, any lessons that can be learned from the recent closing of the Diavik mine, which is owned by Rio Tinto? Any lessons that other mines in the area might be able to take from that?
Yeah, and this may, this will probably leave a bad taste how the Burgundy Caddy mine has gone. But Rio Tinto did an excellent job, I would say, with their closure, kind of a model case for others to follow. And so mining is cyclical. We know it has lifespans. We know it has booms and busts. Governments have to be mindful of these and help manage those, but we shouldn't be surprised when it happens. The idea here would be to try to diversify not only to other sectors, but to other commodities. And I would think, for the smaller territories, you want to be looking for good partners, and you want to be attracted to a variety of commodities.
Interesting. Okay, we'll leave it there. Heather Exner-Perot, Senior Fellow and Director of Energy, Natural Resources and Environment at the Macdonald-Laurier Institute. Great to have you on. Thanks so much.
Thank you.
Up next, oil prices are rising today as traders await progress in peace talks between the U.S. and Iran. We're back in a moment with more on that. Oil prices are rising today. Traders are continuing to anticipate a near-term resolution to the Middle East conflict. However, our next guest notes that beyond the headlines, both sides have made no significant progress in over 2 months, and they remain divided on all key issues. So let's bring in Clayton Siegel, Senior Fellow at the Center for Strategic and International Studies. Good to have you join us. Thanks so much.
Hi, Lindsay. Good to be here.
So if you put aside some of the major sticking points like Iran's nuclear program, sanctions relief, what do you think is still really standing in the way of some kind of temporary peace deal between the U.S. and Iran?
I mean, on the tactical side, but also very important operationally for energy and other commodity markets, of course, is the closure of Hormuz. And so we're moving into our 4th month now of an effective closure of that vital waterway. Before the war, 20 million barrels a day of oil and refined products reaching world markets. And we've had to shut in production in most of those Gulf producing countries to the tune of 14 million barrels per day. Well, when you do that over the course of 3 months, you have a cumulative oil deficit of about 1 billion barrels. And so one of the most important interests for the global economy, especially for consumers, but I think also for oil producers as well, is to resolve that Hormuz bottleneck and restore those vitally important energy exports from the Gulf region.
Another big component here is the fact that Israel is continuing to invade Lebanon. There's reports that Donald Trump kind of lashed out at Benjamin Netanyahu over these continued strikes in Lebanon. Do you think Donald Trump has any kind of leverage over Netanyahu to stop Israel from striking Lebanon so that the U.S. and Iran can reach some kind of deal?
It's hard to say at this stage. I surmise that Washington does still have some degree of leverage over Israel and some of its decision-making when it comes to war fighting and other strategy in the region, but it's not like an on-off switch or a black and white situation. It's degrees of influence. And Israel, to my understanding, is heading into election campaign season, and Prime Minister Netanyahu, who's running for re-election yet again, is probably eager to placate and assuage a lot of the needed coalition partners on the right side of Israel's political spectrum. So this fragile ceasefire that we're seeing between Israel and Hezbollah in Lebanon is just that. It's quite fragile. And the Israelis do represent a bit of an X factor, a wild card, as Trump continues to press the negotiations front with Tehran.
And you mentioned off the top of our chat here that we're entering the fourth month of this conflict, which is a pretty sobering thing to realize. Do you believe that the two sides can come to some kind of a deal to reopen the Strait of Hormuz this month in June?
Well, of course, anything is possible, and it depends on the willingness of the leaders in both capitals to make compromises. And it seems when we have a situation like we have today, which is a complete stalemate, it's paralysis of operations in the Gulf and Hormuz, as we've said. And this is a situation where we basically have a battle of the blockades, right? Iran is not letting out other producers, oil and gas and other commodities. And the United States has in recent weeks imposed, and I think to a degree of success, its own blockade of Iranian exports as well as imports. So we have this battle of the blockade, but the export hiatus remains, and every day this goes on, it gets worse. I think that there are prospects for both sides to maybe climb down from their nice-to-have negotiating positions and really focused on the must-haves. And so if the two sides show that kind of compromise, of course, I think that this war, we can find an exit off-ramp and get these commodity flows restored. But so far, we haven't seen those compromises because both sides believe they have the upper hand, and the other guy's going to capitulate first.
And how might export controls kind of continue to negatively impact the U.S. consumer and businesses, particularly if it results in more crude remaining in the U.S.?
Well, anytime you see retail fuel prices soaring like we have since the beginning of the war, they were just under $3 a gallon nationwide pump price before the war, and now about $4.30 per gallon. So it's up more than 40 cents, even though we're off a little bit from the highs around 4.56. So what that means is we're getting to kind of a political pain point. And I don't have to remind the viewers that in the United States, we're approaching election season ourselves. So I think that ideas like export controls are understandable, but policymakers should really try to anticipate those unintended consequences. And if you sever United States oil companies' ability to service their international customers with export controls, let alone a ban, you'd build a glut in the United States. Refiners would likely respond by cutting runs and manufacturing of those fuels, and ultimately that would back up to the upstream. That has important implications for Canadian oil producers as well, who kind of compete in this market and benchmark their oil and their planning to U.S. oil prices. So those unintended consequences we really have to keep an eye out for. And difficult roads are paved with good intentions, as we know, and so policymakers should have a clear eye about how that could potentially backfire and actually cause higher prices going forward.
Okay, we'll leave it there for now. Clayton Siegel, Senior Fellow at the Center for Strategic and International Studies. Appreciate your time. Thanks for joining us. And thank you for watching Commodities. You can always email your story ideas to commodities@bnnbloomberg.ca. And The Close with Morella Fernandez is up next. Stay with us.